Hello, everyone. All right, let's get started. Excited to talk today about whether you're mortgage tax deductible or not, and how you can take advantage of some of the items like the Smith Maneuver, and some of the more complicated and advanced concepts as well, to be able to look into this. So let's start off with just looking at the basics here. The Smith Maneuver is a great way of being able to utilize your home equity, and some of you may have your home paid off already. And so one of the things we look at here is, if your home is paid off, does it make sense to leverage it to then use to borrow against to invest? Or maybe you still have a mortgage on your current home, but you have a lot of equity in your home. One of the key things that we look at then is, what are some different ways of building your growth, or building your net worth over time? Because ultimately, at the end of the day, if you're just sitting on a house that's fully paid off without any debt secured to it, you are foregoing some advantages, some benefits. Oh, is it echoing? Is it echoing for everybody? Maybe I can check the audio here. Okay, let me know if the voice continues to echo or not. So overall, having a home that's solely paid off is not really working for you. So we always want to look at what's the best way of growing your wealth, because paying down a mortgage is one way of growing your wealth, but there are many different ways that you can grow and build your wealth. One of the questions that comes up quite often is, what should I do with my money? Should I be looking at increasing my investments, or should I be paying down my mortgage? Because both of those things can actually increase your overall net worth. If you increase your investments, of course, those are now working for you and compounding for you. If you're paying down the mortgage, then you're reducing your compound interest that is working against you. So both of these things can work. Now, one of the things that I like to look at is maybe you can do both at the same time. And so the way that we would do this is we would set up a home equity line of credit, or what's called a readvanceable mortgage. And so a home equity line of credit, or HELOC for short, basically what this does is you get a product where, as you pay down the mortgage, the line of credit limit automatically increases for you. So you're always actually able to access additional credit over time as you pay down the mortgage. So let's say that you have a home worth $500,000 and you have a $225,000 mortgage. You could then get a $175,000 line of credit. And what happens is, as you pay down that $225,000 mortgage, the line of credit limit will slowly increase, because you can always get up to 80% of the total property value available to you in total credit. So that means that over time, as you pay down that mortgage, the line of credit limit will increase. Now, there's one little wrinkle to this. The government did about 10 years or 8 years ago, changed it so that you can't readvance dollar for dollar over 65% of the value, meaning that if you're over 65% of the value of the property, every dollar you paid on the line of mortgage will not improve the line of credit limit by $1. It works out to be about 2/3 of the amount that you pay down. So if you paid down $1, then you'll get about 65 cents or so added to your credit limit, because they're slowly over time, they're trying to bring you down to no more than 65% of the value of your home. But the idea behind this whole concept is, now you don't have to choose, do I save up my money to invest, or do I pay down a mortgage? Because what you're doing is you're effectively paying down your mortgage, which is going to improve and increase the amount of equity that you have available to you on the line of credit component. So this allows you to, over time, build your wealth, and effectively create an opportunity for you to borrow money to invest. Now, the key is, why do you want to be borrowing money to invest? The reason for that is that whenever you borrow money to invest, the interest portion of the payments is tax deductible. And so you want to make sure you talk to your accountant and verify anything that's spoken about here as it pertains to taxes. However, if you're borrowing money to invest with the intention of earning an income, then that interest should be tax deductible. And so this is an important key to make sure that you're understanding, okay, what is the right structure and strategy for your residence? And that's because, although borrowing money doesn't seem great, there is a difference between good debt and bad debt. Bad debt is when you're borrowing money for depreciating assets like consumer goods. If you're, putting money on a credit card to go, buy video games, or to buy a couch or something else that depreciates, consumer goods would be considered bad debt if you're borrowing money to buy those items. Good debt would be to buy appreciating assets, real estate, stocks, etc. And then the gold standard here, what we're trying to achieve, is to make sure that that debt that you have is actually tax deductible debt. And so making sure that you structure things in a way where you're able to write off the interest portion of the interest payments, to really transform and make sure that you're borrowing money in the right spot, but it's also tax deductible on a moving forward basis. And the reason for this is that overall your net worth is your goal. It's assets minus liabilities is your net worth. And so when you do this and you're borrowing money to invest, realistically what you're doing is you're adding some money to both ends of the spectrum. If you borrow 200 grand to invest, your assets just went up by 200 grand and your liabilities went up by 200 grand. So in theory, your net worth hasn't really changed. When you're borrowing money on credit cards and whatnot, these things obviously have negative impacts on your net worth, and so you never want to be borrowing money to buy assets that lower in value. But one of the key things in order to be able to grow your net worth over time is that structuring your mortgage to save tax is one of the most important things. It's something that we teach and we talk about quite a bit at Green Mortgage. And so a couple of the things that we always look at here is, as far as the structuring is concerned and how it actually works, is you're making your mortgage payments, and you're reborrowing the principal that you paid down on the line of credit, and then you're investing. And when you borrow money to invest, you get to write off the interest portion of the payments, and you get to save money in your taxes. Again, we talked about this really briefly, but the use of funds is really, really important here. It's important that you're not buying consuming goods. So those types of items are not tax deductible. But if you are borrowing with the expectation of generating an income, that makes it tax deductible. Now, one of the cool things you can also do, which also grows the net worth, because yes, if an asset and liability are the same, but what might happen over time, however, you buy an appreciating asset that grows faster than the debt does, then you can also create a spread between the cost of borrowing and what you're investing at. So if you found some investments that you could invest at 8% and you're borrowing on a line of credit, right now a line of credit is generally prime plus 0.5%. So prime plus 0.5 is 4.95%. If you're creating a spread between those two of about 3%, then you're creating and earning 3% spread on all of that money that you borrow. Now, obviously, that's assuming that the interest cost remains the same. It's also assuming that your investment gains remain the same. But there are a lot of investment opportunities that make relatively consistently around 8%. And then the borrowing costs, when you get a home equity line of credit that allows you multiple tiers instead of the product, you can actually chunk out different tiers and components of that and then lock those portions in. And you can get mortgage components there. So different lenders allow different numbers of rental or different numbers of mortgage components inside of it, which means that you could borrow 100 grand for that investment and then lock that into maybe a 5-year fixed rate. Maybe it's a long-term investment for you. And then another component, maybe you lock in for just a 1-year term because you're planning on getting the money back in a year and you want to be able to pay off that loan. And some of it, maybe you're day trading in stocks and you actually want it to be on a line of credit so you can go in and out and only pay interest if you're borrowing the money. So you can actually have multiple segments and components inside of the product, which is really key. But if we start to really dive into it and look at, what is the overall objective here in trying to structure things in an ideal world. If you had a primary residence that was worth about 800 grand and had a $400,000 mortgage on it, an interest rate of around 5.5 or 4.5%, they had mortgage payments of about $2,300 a month. A really simple outcome here, if you're earning $150,000 a year, marginal tax rate would be well over 40% at that point. If you had a rental property that was worth 800 grand and your mortgage amount was $680,000 and also had an interest rate of 4.5%, one of the cool strategies that you can use is actually to do something called cash damming. And I'm going to talk a little bit about that in a couple of slides. But one of the ideas here is that you're actually taking the rental income and using that to pay down your personal non-tax deductible mortgage. And the overall outcome that you get in this case is that over 22 years, as you're paying down your personal non-tax deductible mortgage, you'd have actually saved 103 grand in taxes. And all of all of your debt that's 100% tax deductible would only be in 65 months, and all of the debt would be reimbursed over just over 20 years. So overall, if you were to just look at the number of months that you've actually saved in interest here, it would be 43 months. It's quite significant. So the tax strategy makes a lot of sense, especially if you employ it there are extra steps in order to be able to do that. But when you're doing the analysis and trying to figure out and look into, okay, does this make sense for me? What are the different mechanics of it? There are some tools that you have accessible to you. And so one of the things that we like to look at first is, does it even make sense high level? What type of situation are you dealing with, and what is your circumstance? And then run some numbers on that. And it's pretty easy for us to do some really high level numbers. And I'll get into in a second some of the examples and situations where we've done, we have a more in-depth analysis that can be done. But here are three examples I wanted to bring up because it's a little bit easier to understand, like, what about my circumstance? Where does this apply to me, and does it apply to me? So just a couple of weeks ago, we had a client that actually just sold his business. He did very well, and he sold it for over $8 million, and he's buying a new residence for about $2.3 million. And so initially he was thinking, hey, Kyle, I want a mortgage on this property. What's the interest rate, et cetera, that I can get? And we started talking about it. And I thought, well, if you are to liquidate those investments and basically have a line of credit you clear off when you close on this purchase, and now you re-borrow the money back out on the line of credit and then invest those funds back into the investments that you have. Now what will happen is you're actually transforming and converting that mortgage from not being tax deductible to being tax deductible. And so in this particular case, the client is getting a good rate on the line of credit. The bank gave him prime on the line of credit, which is good. So we ran those numbers, and just using an approximate number of about 4.5% interest, if you've now paid off that $1.5 million and reborrowed it back out and then put it into the investments, now you're able to write off the interest portion of the payments. And I noticed I actually just made a bit of a typo here, so I put the amount $27,000 here twice, but the amount actually was about $60,000 of interest on at 1.5 million, 4.5% interest. The interest cost that's being written off was about $60,000, and at about a 40% tax bracket, this client saves $27,000 a year in taxes. Now, over time, that would be if you just stayed on the line of credit. Over time, if you locked it into a mortgage, which is amortized, each year that you pay down the mortgage, the interest amount of those payments slowly goes down because some of that is principal that you're paying down. But it's a very significant amount of interest that would be able to be written off, and therefore a significant amount of taxes that would be saved. It's in the hundreds of thousands of dollars in that particular case. Now, we can also break this down to simpler things. I mean, not everybody on this call is going to be selling a business for $8 million and be in a luxury of a circumstance that would allow them to save a bunch of money in taxes that way. Where I see probably more examples and more basic scenarios where borrowers can take advantage of this is just putting a little bit of extra down payment. So we had a borrower about a month ago that was going to put the 20% down, and they wanted to preserve their money in their investments. In that case, they had an extra $200,000 in some of their stocks and some other places. And so we recommended, hey, look into this with your financial planner, see what the costs are to sell those stocks and then get out of those positions, and then put $200,000 down extra on your home, but get a line of credit available for that amount. And then right after closing, re-borrow the money off the line of credit and put it back into the investments. And so there's usually some kind of costs because you have two things you have to consider. Number one, you'll have potentially capital gains when you sell those assets. If the assets went up in value, you might be triggering capital gains. And so there might be a tax event, but it would be generally a one-time event that you'd have to pay for that. And then there's also just the selling and buying of those assets. So there's usually trading fees and whatnot, which are usually quite minimal, but there may be some trading fees that you have to account for when you're getting in and out of those stock positions or whatever financial position you're in. That being said, the amount of tax savings that you're getting, like in this case, the client was at a lower tax bracket with 35%, but that's $3,150 per year in taxes. And every year that number goes down just a little bit as the mortgage gets paid down. But it's quite significant, and the amount of taxes paid by selling off those assets was not that significant, or was predicted not to be that significant. So these are a great strategy for a lot of borrowers that are looking at buying their own personal residence, and it's a really simple strategy where, hey, maybe put more than you want down, knowing that you can put the money back into the investments right after you close on the purchase. The other thing that I wanted to bring up is a very I wouldn't call it necessarily a simple strategy, but it can be relatively simple in nature as far as your portfolio not needing to be really complicated. So there's a concept in a strategy called rental cash damming. So we have a situation where a client had about $3,700 in rental income, and they're using a cash damming technique to pay down the primary residence. So the CRA allows you to do is you can actually take your rental income from your rental property or properties. So it's even better if you have multiple rental properties, by the way. You could take the rents from your rental properties and use those rents to pay down your personal non-tax deductible mortgage, which then opens up the line of credit, and you have additional credit available on your line of credit. And then you can put your expenses related to your rental properties on the line of credit. So you're really accelerating and increasing the amount of tax deductible debt and paying down the non-tax deductible debt very quickly. In a really simple example of this, there was a client that saved about $63,000 projected over the amortization of their mortgage just by using this strategy to do the rental cash damming. So it's a really interesting and a really cool strategy. It's not that complicated in itself, but I will say it is administratively intensive because you have to do every single month. You have to go in and out of this product. And in and out of the bank accounts. And this is where things often fall off the rails because people don't want to do it. And every monthly transaction doesn't really move the needle a lot for you. You might be moving a couple grand from not being tax deductible to being tax deductible, and you're kind of nudging it like this. One of the key things that's important to know, this works when you own the rental properties personally, but not when you own them corporately. So that's an important distinction. If you own it in a company name, then that company and you are considered separate individuals, and that generally doesn't work. There are some circumstances where maybe some money is tied in together, but almost in every circumstance, that type of strategy and structure does not work to save money in taxes. So that's something that you want to keep in mind for sure. Is that there are some circumstances where it doesn't work. And the fact that every month you do have to make these transactions and you have to bounce the money back and forth. And most banks, for their line of credit product, it doesn't act like a checking account. And so every single month you have to take money from the rental income, make a lump sum prepayment on the mortgage every single month, and then the line of credit increases. And then you have to take all the expenses and move them from your bank account onto your line of credit. You have to track all of this every single month to make sure that you're compliant with the CRA. So it is a lot of effort and a lot of work to be able to do this. So just keep this in mind. As an example, when we look at like the structure for this, Manulife is, by the way, one of the banks that we like for the cash damming structure, and I'll explain why in a second. But basically, what you're doing is you're actually moving this money around quite a bit. So the rental income lands in the personal checking account, and then you put it into your primary mortgage account. So now you're into your HELOC next. So now you're putting into your HELOC. And then what you're doing is you're making a lump sum prepayment on your fixed term mortgage, and then you're moving the remainder of the funds over to what's called your clearing account, which is then used to service all of your rental expenses. So there's all of these moving parts, and it is relatively complicated. There are because you're moving the money around on a monthly basis, there are some key differences. Now, with the Manulife product, one of the key distinctions here is that the line of credit can be used like a checking account. So you can actually produce that account, and then you can have expenses go directly into it. So it's a little bit easier, cuts out one of the extra steps of having to move the money over from a checking account to your line of credit, because you can't have the money land directly into the line of credit account. So it is simpler, easier to execute. Manulife is not always the right product for a good person. They don't always have the best mortgage rate available at that moment. There's different nuances there and things that we'd have to consider, but sometimes it can be a lot easier to utilize when we're looking at the cash flow dam accelerator move here. So something to think about and consider. I do have a question here, so I'll go ahead and answer it from Susan. So can you write the line of credit interest payments when the funds are used for investments, or does this work for HELOC only? So technically, when you borrow money to invest, it does not have to be a HELOC. It can be a personal line of credit or an unsecured line of credit too. It can be a different type of loan arrangement. You could have a home paid off and then just get a mortgage. It doesn't have to be a HELOC. But generally speaking, the HELOC gives you more flexibility and is a bit more suitable towards investing and for clients that want to invest. And so we usually recommend a HELOC wherever possible. But technically does not define and say that you must borrow money from a home equity line of credit product. It just says that you have to be borrowing money to invest for the interest portion of the payments to be tax deductible. So that's a key distinction. Now, one of the cool things that we recently launched is there's now a much better way of kind of mapping out strategies for clients, and we can start to look at different ways of doing this. So there are different strategies, and they have fancy names. So there's the plain Jane, which is just, hey, I'm going to make a lump sum on the mortgage and then reborrow it out and put it into investments. But there's also some nuances. If you're self-employed, then the structure and strategy can be a little bit different. And so there's all of these different strategies that can be utilized here. And so we actually have a cool tool that allows us to map out different strategies for our clients and then propose options. And it'll actually map out the projected tax savings, which is really cool. And one of the key things that we also do is make sure that when we're developing the strategy, we work with your accountant or an accountant that we choose is very familiar with the Smith Manoeuvre, which is often a recommendation. And we build out the strategy. So we enter in all the key details. We figure out which lender we're using because every lender has a different way of structuring things. So we select the lender, make sure we know what type of product we're using. Enter in your tax information and tax rate, what the tax refund settings would be, and all this stuff. It actually maps out a great visual that shows you, hey, if you did this, this is what the tax savings would be, this is what the interest savings would be, this is what your net worth would look like if you employed this option, how much faster you could pay off the mortgage, and a lot of cool things. So it's a very useful way of looking at it. There is a fee for this service, by the way, especially because we're usually connecting with the accountant and trying to build this out. But for those of you that are trying to figure out if this is right for you, what the potential tax savings might be, this might be of use to you. We charge $23.95, so $2,395 to do this, and then we usually offer some discounts for people that have used this for their mortgage services. So if that's something that is of interest to you, then feel free to reach out to us, and we can definitely do that for you. Now, if you're wanting to do this, one of the key components, of course, is if you want to borrow money to invest, then what do you do with the money? Where do you invest the money? And this is the next section or the next stage. The often, one that we usually find our clients have been doing is investing in real estate, buying cash flow rental properties, the pretty standard way of looking at it. But you could also invest in stocks, invest in growing companies, or doing private lending, private equities. There's lots of different options. It is hard to choose sometimes. And so one of the things that I look at is trying to give our clients a bit of a breakdown of the expectations for what the differences are between some of the different investment opportunities. When you're looking at purchasing real estate, for instance, you have to qualify for a mortgage. Whereas if you're going to be just a private lender, like lending out your money, then you don't have to be qualified for any purpose or reason. When I say private lending as well, this could entail you investing in what's called a MIC, which is a mortgage investment corporation. Investing in a mortgage corporation like that, usually returns are pretty safe, and they usually tend to be pretty static, around the 8, maybe as high as 8.5% return. But it's nice and safe and reliable, so there's not a lot of ups and downs with that type of investment, and your money's always working for you. Where if you're a private lender, then you're lending out your money and then sometimes getting it back, then sitting on the cash and then waiting for another deal to arrive. So sometimes it can be a bit of a lag there. And now, if I look at the overall return on investment, real estate, and I'll say that as of now, in this current climate, I would say that the projected return in investing in real estate would probably be a little bit lower than 16 to 22%. A lot of the deals that I'm analyzing right now for residential real estate anyways are probably between the 13 to 16% range. Private lending is usually between 6 to 12%. Most MICs are, again, around 8 to 8.5%. Investing in exempt market dealers, it depends on the investment. So an exempt market dealer is somebody that takes your money and then invests it into what's called private equity. So that could be somebody that's building an apartment building and raising capital to do that, or some larger project that you could get a piece of. And then stocks, the average typically long term is usually between 5 to 10%. Obviously, the last couple of years, people have had a higher rate of return than that. At the current moment right now, people are a little bit more concerned about what kind of expectations they'll have on their investments in stocks. So we're finding more people are thinking, maybe I'll get into something different. But when you look at the cash flow returns, specifically buying real estate, and this is where, in general, the returns are a bit lower in today's climate. I do find when you put 20% down, the return on investment from cash flow in real estate is actually often negative or maybe 0% if you're finding something that's pretty good on the cash flow side. When you're a lender and just lending out the money or investing in a MIC, it's all cash flow. There is no appreciation return. There's no mortgage pay down return. An exempt market dealer kind of depends on the type of deal that you're looking at, and then stocks it might be between 3 to 6%, especially if you're investing in like a portfolio where there's a kind of a mix of different investments that you're in. And the timeline on investment, purchasing real estate, we usually tell people it should be like a 5-year plus type of commitment. When you're doing private lending, usually about 1 year plus. Exempt market dealer, depending on the deal and the type of transaction, it can be 3 to 7 years, and often people just kind of roll their investments into the next deal that comes along. And then stocks could be 1 minute to 1 lifetime. It really depends. Some people buy stock and just hang on to it forever. You can also day trade and just be in and out of your stock positions if you want to. So very different. When you look at the payout frequency, buying real estate, you're getting monthly cash flow, and then upon the sale or refinance is when you can get a payout. When you invest in private lending or MIC, often that's monthly, quarterly, or annual. Most of them are monthly or quarterly for their payouts. When you get to an exempt market dealer, sometimes these are monthly, sometimes they're quarterly, and sometimes at the very end of the term or project. And then stocks, that kind of depends on the nature of the stocks. Volatility, when you're dealing with real estate, I would say it's medium. There's not as much volatility in real estate. It's really what happens with the real estate values. Probably more volatile today than it has been in the past, I would definitely suggest. With private lending, it's quite low, assuming that you're doing low risk lending, which is usually our recommendation. Exempt market dealers, usually low to medium, kind of depends on the nature of the deal. And the stocks have lots of volatility. They tend to go up and down all the time. On liquidity, real estate is fairly low in liquidity, meaning that if you wanted to get your money back, it's going to take a lot more time. It could take you months to sell your property and get your cash. Private lending is medium. Sometimes they let you redeem right away. Sometimes you have to wait until the end of the quarter or the end of the year or whatever the windows might be. So there might be some restrictions for that. Exempt market dealer liquidity, that often is low too, because usually you can't get your money out until the end of the project, but it depends on the nature of the deal. And then stocks are very liquid. So those are one of the benefits of investing in stocks. And then RSP eligibility, for those of you that have a lot of money in RSPs, buying real estate is generally not RSP eligible. Doing private lending, however, often is. So there are ways that you can make that RSP eligible. Investing in exempt market dealers often is, and then stocks usually are as well. So there's more availability for being able to invest through stocks. But overall, I think the idea here is that we have some clients that have come into us, and I've actually had, I think, 3 of these conversations in the last couple of weeks where people are just looking to diversify. One of our clients has a home that's totally paid off, and she's thinking, well, I don't know, should I sell it? Should I do this? Should I do that? And there's not really a great time to sell, but she kind of wants to make sure they have some assets in different spots. So we're looking at maybe $1 million line of credit to then take those funds and then kind of sprinkle it into a couple of different types of assets. And spread out the diversification a little bit, because all of their money is all in real estate and it's all paid off, but very little in the liquid asset category of stocks and whatnot. So what a lot of our clients are doing right now is they're reducing their payments and paying off their high interest debts by refinancing. So that's step number 1. Like if you are still carrying high interest debts and whatnot, then you should be looking at refinancing and reducing your high interest debts by refinancing first. And then the next thing is learning how to properly structure your mortgage, because you might be able to save thousands of dollars in tax with some very simple changes. You might have a mortgage right now and you might have some additional assets on the side. Often when clients come up for renewal, this is a great opportunity to look at that and say, hey, can we redesign or restructure the mortgage to be more tax efficient when you're coming up for renewal? But you can even do this midterm if there's a circumstance that would warrant that. And then, of course, if there are opportunities, and maybe you don't have an opportunity to go right now, but a lot of the time when we have a client that's maybe interested in investing, getting access to the capital so that they can then have it available when an opportunity arises, and then earn a spread on the interest cost versus the return on investment, and utilizing their home equity to buy rental properties or to invest in other assets. So if you don't already have some kind of a retirement strategy, it'd be really important to start to get one, and that's where we can help. We can help with the design of structuring things, making sure that your mortgage is working for you and not just for the bank. And if you ever want to learn more about this, we have more information on our website. You can also email us too if that's easier. In order to get our investor survival guide, we have more private lending packages if you want to learn more about that. If you wanted to learn about investing in mix, you can email us and learn a bit more about some of the opportunities that and some of the lenders that we do a lot of business with that we feel really comfortable with having clients park their money in. And of course, we do these webinars every month. And if you do want to learn more about your mortgage, seeing if it's structured properly for taxes, if you wanted to learn more about the Smith Manoeuvre and some of the cash damming techniques, some of those advanced strategies that might require a little bit more of a structure and a game plan and a bit more administration, then book a consult with us, and then we'd be happy to walk you through that. And then for those of you who don't know, I did write a book, I guess, it's coming up on 6 years or 7 years now, called Rockstar Real Estate Investing. And so if you'd like a copy of that book to learn more about investing in real estate, then shoot us an email and let us know you'd like a copy of the book. And if you'd like to reach out to us, then feel free to send us an email at info@greenmortgageteam.ca, or you can call us at 604-229-5515. So I hope that was informative for everybody. I'll open up for some questions. So if anybody has any questions that they'd like to ask, you can put it up in the chat, and I'd be happy to answer all those questions. There's also a Q&A as well if you'd like to put the question there. No questions? Usually this topic has more questions. Usually it's a bit more it's a bit of a complicated situation and circumstance with the taxes in particular. And I will say that taxes are it can be a bit confusing. One of the things that we do handle quite a bit is actually helping people with pointing them in the right direction on how to deal with things from a tax perspective, because the tax is a very important component of developing and setting up the mortgage properly. So yeah, if you have any questions about that and need to learn more, then let us know. There's a question here. Do you offer services to set up the Smith Manoeuvre for someone who has an existing readvanceable mortgage, and what is our fee for that? So send us an email and let us know. I mean, realistically, if you already have a mortgage, then we'd have to do that outside of the mortgage, and that would be setting up that Smith Manoeuvre structure, which I mentioned was $2,395. So if we're not doing a mortgage, then that's the fee to set that up. So if you'd like to send us an email, and then we can give you some more details about what to expect, and we can even punch in some numbers for you to see what your potential tax savings might be to employ that strategy. When you look at the amount of taxes, if you do it properly, the amount of taxes that you could save is quite significant. So it's often worth it. But in some cases, if you don't have the components needed to save the taxes, then sometimes it's not worth it. Or sometimes it's a really quick scenario where you just say, hey, all you need to do is just do this one thing, and then you can save X amount of taxes. So you might not need a complex strategy. So if you just send us an email and with more details about your situation, I can let you know what's probably the more suitable situation and scenario for you. Let's see here. So there's one more question in the chat, and then I'll go to the Q&A. So Graham, hold on, there's one more here. Adam has a question. So I had a question about the extra money being put down. Your example of the person saving $3,500 in taxes but paying $9,000 in interest. So would it not be better to keep the money and invest it directly? So let me clarify that particular item here, because what's happening is if they only put their 20% down, then they'd still have that mortgage payment anyways. What they did is they reduced their mortgage and then had a line of credit for the difference. So they still borrowed the exact same amount, except out of that mortgage, $200,000 is now tax deductible. And so that $9,000 on the $200,000 portion is the amount that they're able to write off and save the taxes on the $3,150, I think it was, per year. So overall, if they just only took out the 20% down to put on their down payment, they'd still have that mortgage. But instead, what they did is they put an extra $200,000 down. So now out of the whole mortgage, now this component of it, borrowing the same amount, at least this $200,000 is tax deductible. So it's if they still have the same amount of interest, except $9,000 of the interest cost is tax deductible. And then Graham asks, you mentioned making mortgages more tax efficient. Is this outside the Smith Manoeuvre strategy? So it really is the same strategy. The Smith Manoeuvre books 1 and 2, there's a second book that came out, I want to say about 10 years ago, that had a little bit more color to the advanced strategies. But I mean, I know that the Smith Manoeuvre kind of covers all of these. So technically, if you were to say, oh, is the Smith Manoeuvre like all of the tax strategies? They do a really good job of it covering all of the components of it. So, there aren't any like strategies that I'd recommend that fall outside of one of those like specific, subset strategies or conversations. There are some other conversations that we have with clients, however, where it comes to, hey, clients, should I buy or rent a property in a personal name or a company name, and types of some of those conversations. That's where it's not really a Smith Manoeuvre conversation. It's more of a, what's the overall best strategy to grow your wealth? And sometimes getting a mortgage in a company name can be more expensive. There might be fees, higher interest rates, et cetera, but then there could be tax benefits to doing it. And that's where we can review the company financials and say, oh, well, you actually have a whole bunch of money you can repay yourself via shareholder loans without paying taxes. And so then you could take out all the money in the company to yourself personally and then use that to invest. And that actually might be a better tax strategy, because then you're just utilizing that to get money out of your company. And in fact, even in that strategy, you take the money out, pay down your personal non-tax deductible mortgage, and reboard the money back out and create a tax deduction for yourself. So there's multiple components of it, especially if you have companies and you have your personal holdings too. So yeah, I guess there's a couple of things that would fall outside of the Smith Manoeuvre strategy, because generally the Smith Manoeuvre is more for personal investing and personal borrowing. But there are some strategies where it starts getting intertwined with the corporation side of things. And that's where we're very in tune with the different implications and for all things legal, accounting, and the mortgage, of course. I have another question in the Q&A. So do you recommend investing in something that fully covers the interest, like private lending or dividend ETF? Or do you recommend more growth-oriented portfolio where interest expense is higher than the income and increase the tax refund? So that's a partially financial planning question, to be honest. So what I do find in general, when you're younger and you have more time for that growth to occur, then usually growth stocks outperform the dividend stocks in general. And that's just because usually when you're investing in growth, you don't get the immediate benefit today, but you get the benefit in the future. And I think when you look at like the type of companies that you're investing into, if they're a growth company, like if you bought Amazon 20 years ago, they weren't paying out dividends, and I actually don't know if they're paying out dividends today, but I wouldn't imagine they are. It's one of those things where you're investing in what they're going to be in the future, and a company like that that's growing can't afford to pay dividends because they want to invest that money into the company to earn a higher valuation in the future. And so in general, then, if you're if you're a younger individual, then usually you go for more of the growth side of things, and which could also be considered the higher risk type of investments. But you have more time to see it through, and then eventually a few of those pop, and then you have a big increased evaluations. As I do find when you get closer to retirement, two things happen. Number one, your investment objective changes. It's less about growing the assets as much as possible, and it's more about trying to ensure that you can have the money tomorrow, as opposed to starting to lose it, right? So usually people start to take some risk off the table. That's the first thing. Second thing is people often start to transition into earning an income because they need to think about replacing their income heading into retirement. So that's where you're going to find that the investment objectives start to change as people get a little bit older and head into retirement. So yeah, it's hard to answer that question without having more details. And I'm not a financial planner, but we do provide a lot of that, high level advice to clients on what I would recommend. And then that information can be, of course, run through your financial planner to get some feedback. Any other questions? Okay, well, maybe we'll wrap up the presentation here. Thanks everyone for coming out. Feel free if you have any questions and you'd like to dive into this, then just reach out to us. You can email us. I mean, I'm sure that many of you might have more personal questions about your personal circumstances. So feel free to reach out and let me know if you'd like to go into some more details there. But yeah, happy to have one-on-one conversations if you guys have more specific questions. And yes, Shane, we have recorded this, so we'll send out a copy of the recording out to all attendees so they can check it out and review this for the future. So if you did register for the event, then you'll get a copy of the recording. And then if you have friends or family that are interested in learning more too, you can feel free to share this with them. We also do post this on YouTube as well. So we have a YouTube channel that has all of our previous webinars. We usually post this to YouTube within a day or two, I think. Yeah. Awesome, everyone. Thanks so much for coming out. Looking forward to hearing from many of you in the future. Thanks a lot.